Globalization, the growing interconnection of economies, cultures, and populations, has dramatically reshaped the foreign exchange market, or forex. As global trade expands, companies need to exchange currencies. Global investors constantly move money across borders, buying stocks, bonds, and properties. These capital flows drive currency demand and influence exchange rates.
Good day everyone and Assalamu alaikum. My name is Amira Hasna Grantos, and in this video, we were going to talk about the demand and supply shift in foreign exchange. How the foreign exchange market operates, how exchange rates are determined, and what causes them to change, and how expectations play a major role in currency markets. But first, let us discuss what is the foreign exchange market. So, the foreign exchange market, often called as forex, is a global marketplace where different currencies are bought and sold. Participants in this market includes the firms, households, investors, and financial institutions. They use this market to exchange one currency for another, often through commercial banks and major currency dealers. So these were the primary purpose of foreign exchange markets. So first is the facilitating international trade, second is enabling international investment, and third is the currency conversion for travelers. In facilitating international trade, businesses need to convert their currency to pay for goods and services imported from other countries and to receive payments for exports. The forex market provides the mechanism for these conversions. Enabling international investments. Investors can use the forex market to buy and sell foreign currencies, to invest in assets like stocks or bonds in other countries. Lastly, the currency conversion for travelers. So, travelers need to exchange their home currency for the currency of the country they are visiting to make purchases. Now, let us take a look at how this foreign exchange operates with the example of US dollar versus the Mexican pesos. Let's look at how exchange rates are shown using the supply and demand. In this figure, using the US dollars as the basis for the exchange rate, the exchange rate on the vertical axis is showing how many Mexican pesos are needed to buy 1 US dollars, and the quantity of US dollars traded on the horizontal axis. With this, the demand curve for US dollars intersects with the supply curve at a point of equilibrium. In this example, the exchange rate is 10 pesos per dollar and the daily trading volume is 8.5 billion US dollars. Now, let us take a look to the perspective of the Mexican pesos when converting to US dollars. So the vertical axis shows the exchange rate as US dollars per peso. In this case, with $0.10 or 10 cents. The horizontal axis shows the quantity of Mexican pesos traded. The equilibrium remains the same, just viewed from the perspective of Mexican pesos. Here, 85 billion pesos are traded daily. Given with this example, what causes exchange rates to change? A key factor is market expectations. If investors believe a currency will increase in value, they will demand more of it. If they expect a currency to lose value, they will supply more of it or sell it. For example, if a major news outlet predicts that the Mexican peso will appreciate, investors will rush to buy pesos. This increases the demand for pesos and reduces the supply since fewer people want to sell it. So, this is the effects of changing expectations. In this figure, it shows what happens when people expect the peso to rise in value. The demand curve shifts to the right, and the supply curve shifts to the left. As a result, the peso strengthens from $0.10 to $0.12, and the amount of pesos traded increases to 90 billion. Before it was 85 billion, now it is 90 billion. The new equilibrium reflects both higher demand and lower supply. But how does these expectations happen quickly? Expectations can change rapidly. If many investors believe a currency will strengthen, their actions can actually cause its appreciate. That appreciation then encourages even more investors to buy in. This creates a self-reinforcing cycle, and it's one reason why exchange rates can shift a lot in just a few days or weeks. To conclude that, exchange rates are set by supply and demand in the foreign exchange market. Expectations about the future are powerful and can move both demand and supply at once. These changes can cause currencies to appreciate or depreciate quickly. And that's it for my discussion. You can proceed to Ms. Sandara's report, which is the continuation of demand and supply shift in foreign exchange. Thank you so much for listening.
Hello everyone, this is me, Sandara, and now let's proceed to differences across countries in rates of return. First, what is rate of return? Rate of return is when people invest money, whether in business, stocks, or savings, they expected to earn a profit or interest. That is called a rate of return. The higher the return, the more attractive the investment. For example, you are an investor. If US investments give you 5% return and Mexican investments give you 2% return, where would you rather put your money? Probably in the US, right? That's because higher returns attract more money from investors around the world. What happens in the foreign exchange market? So, to invest in another country, you first need to buy that country's currency. For example, if someone from Mexico wants to invest in the US, they'll need to buy the US dollars. This increases the demand for the dollar. At the same time, fewer people will want to exchange dollars for peso since investing in Mexico gives lower returns. So the supply of dollars in exchange market goes down. So there are two currency value changes in the foreign exchange market. The first one is the appreciation. When we say the appreciation, it is when a currency of a country gains value compared to another country. For example, if 1 US dollar used to get 8 pesos and now it gets 9 pesos, the dollar has appreciated. The next one is the depreciation. It is when a currency loses value compared to another. For example, in February 3, 2023, Philippines has experienced a period of appreciation against US dollar with around 53.61 pesos per US dollar. And as of May 2025, the Filipino peso has experienced depreciation against the US dollar. And currently, the exchange rate is approximately 55.68 per US dollar. For it to be more understandable, let me show you how it works. So we have the graph. On the vertical line or y-axis, it shows the exchange rate of pesos per dollar, while the horizontal line or x-axis, this shows the amount of dollars traded in the foreign exchange market. The demand curve or D0, this refers to the original demand for the US dollars. Meanwhile, the supply curve or S0. This refers to the original supply of US dollars. And the equilibrium point or E0, this is where the demand and supply meet, showing that the exchange rate is at pesos per dollar and the quantity traded is 8.5 billion dollars. So let's say that the demand for dollar increases due to its higher return and more investors of course around the world wants to invest in the US. In this case, it will create a new curve. The demand shift right or D1 means that more people want US dollar to invest which increases the demand for dollar. Meanwhile, the supply shifts left or S1 means that fewer people are willing to trade away their US dollar, an indication of decrease in supply. Now, the new equilibrium or E1 have made. It indicates that the exchange rate rises from 8 to 9 pesos per dollar and the quantity traded stays the same. The increase and decrease from 8 to 9 pesos per dollar reflects the increase and decrease of the demand and supply. Now, let's proceed to relative inflation. When we say relative inflation, this talks about how high inflation in a country can weaken its currency in terms of foreign exchange market. When a country has a higher inflation than others, its currency loses buying power. People, especially investors from other countries, don't want to hold a currency that's losing value fast. For example, Mexico in 1986 to 1987 had inflation with over 200%. As prices in Mexico arose, the peso lost value, making it less attractive to hold or trade. As a result, the exchange rate dropped, meaning more pesos were needed to get 1 US dollars. And what will be the market reaction? Of course, the demand for pesos falls, meaning that foreigners don't want it, and the supply of pesos increases. People want to exchange it for more stable currencies like US dollars. These two forces, the demand and supply, drive down the exchange rate. Peso becomes worthless in terms of dollars. Now, let us go to purchasing power parity or PPP. The PPP means that in a long run, exchange rate should adjust so that the same product costs the same in different countries when prices are converted to a common currency. Why should prices match across countries? Of course, if a product like car is cheaper in one country than another, people in businesses will buy in a cheaper country and sell it in the more expensive country to make a profit. For example, suppose 1 US dollar is equivalent to 1.30 Canadian dollars. A car that sells for $20,000 in the US should cost $26,000 in Canada because $20,000 times 1.30 is equal to $26,000. What if prices are different? Of course, let's say that if a car in Canada are cheaper than $26,000, Americans will buy in Canada. And if a cars in Canada are more expensive than $26,000, Canadians will buy in the US and sell it to a more expensive country. This process is called arbitrage. Why use PPP when comparing GDP across countries? Let's say that you are trying to compare the size of Japan's economy to other countries in US dollars. You have two choices. The first one is the market exchange rate. It is what money trade for in the real world. The next one is PPP exchange rate. It is based on real life costs and prices in each country. The problem is market exchange rates jump up and down a lot, which can make a country look richer or poorer than it really is, even if nothing changed in the economy. For example, Japan's GDP in yen is 500 trillion yen, same in 2014 and 2015. In 2014, 1 US dollars is equal to 105 yen. GDP looks like 4.8 trillion dollars. While in 2015, the 1 US dollars is equal to 121 yen. GDP looks like 4.1 trillion yen. But Japan's economy didn't actually shrink. It just looks smaller because the yen got weaker in the market. PPP avoids this problem because it uses a more stable rate that reflects the actual cost of living, not just currency trading. PPP helps predict long-term exchange rates. In short term, exchange rates move because of inflation differences and interest rates. So, the economists use PPP to make better comparison and predict future trends in currency values. You guys may be wondering why it is always the US dollar. It's simply because the US dollar is seen as a dominant global currency due to several reasons. The first one is global trust and stability. The US has one of the largest and most stable economies. Investors trust the US government to honor its debts, making the dollar a safe asset. The second one is reserve currency. Central banks around the world hold the US dollar as their main reserve currency. More than 50% of global reserves are in dollars. It includes the Japan, China, Saudi Arabia, and so on and so forth. The third one is trade and oil pricing. Most global trade, especially oil and commodities, is priced in dollars. This increases demand for dollars. The fourth one is global investment. Many international transactions, loans, and bonds are issued in US dollars. And the last one is size and influence of US economy. As one of the largest economy with significant global influence, US shapes financial systems and policies around the world.